Good afternoon, Reggie Empire back at you. And boy, oh boy, oh boy, are we seeing some CapEx spinning. We talking about the big boys. Who is that? We're talking about Microsoft, Meta, Amazon, and etc. So let's get it. So what we got here, we got Google, Meta, Amazon, and Microsoft. Combined capital expenditure plans have now been pushed higher again, with estimates reaching as much as $725 billion in 2026. And after adding roughly $10 billion, forcing investors to assess whether the scale of spending is beginning to translate into tangible returns. Meaning they questioned them before about the CapEx spending. They had their earnings, they're like, oh, okay, they're making some money. Yeah, I think Google made $109 billion, killed the top line. We're also going to talk about how much weight does NVIDIA have in all of this in the Mag 7. And we're also going to hear what Dan Ives have to say, and we're going to go back in time just a little bit, just in case people think the AI bubble was here. Here we go. The companies pointed to $20 billion in quarterly cloud revenue. Right here, Alphabet is starting to show what Payoff could look like. Like I said, they were questioning before. The company pointed to $20 billion in quarterly cloud revenue ahead of the 18.4 projected, alongside with what is described as meaningful acceleration driven by demand for AI software infrastructure. It's not slowing down, guys. Not a financial advisor. I'm just reading what the experts are saying. Backlog climbed to more than $460 billion, nearly double from the prior quarter. Shares gained 6.6, closing market late trading day. Meta, by contrast, faced more difficult reaction, with shares falling more than 6% after it lifted full year capital expenditure guidance to as much as $145 billion, partly reflecting higher component costs. That's true. Things are getting expensive. Gas is going up, diesel is going up. They gotta pay that. They gotta pay the same thing. They gotta pay delivery costs, right? The company does not have a cloud business to direct monetize AI infrastructure, and its standalone AI app has seen relatively lower engagement. While Zuckerberg indicates the company does not yet have a precise plan for how each AI product will be developed. Elsewhere, Amazon reported 28% growth in cloud division, the fastest rate since the second quarter of 2022, which could be read as a proxy for strengthening AI demand. There it goes again. Supported in part by the ties of OpenAI and Anthropic. Microsoft said it expects Azure revenue to grow about 40% at the current quarter, with further acceleration anticipated later in the year. Though adoption of its Copilot, it's a good AI program, I actually use it, tools remain gradual, with paid seats reaching 20 million. Now let's do this. Do this really quick. Let's do the quick read. Microsoft shares dropped even after the company posted quarter-three revenue of $82 billion, up 18% year over year, with AI revenue hitting a $37 billion annualized run rate, which is 123% year over year, and Azure growing 39%. Wall Street is punishing massive Microsoft AI spending without visible near-term returns, while doubts about OpenAI performance and Anthropic competition raises questions about Microsoft infrastructure investment payoff. The analyst who called NVIDIA in 2010 just named his top 10 stocks. Microsoft wasn't on them. Microsoft is down 5% in mid-trading day on Thursday. Changed hands near 402 after closing Wednesday at 424. The slide arrives despite clean physical third quarter beat. Right? So let's go over here. You remember the 1990s when they were layering fiber optic? Well, here we are. 1990 build out of fiber optic. This is what I'm talking about. History doesn't repeat itself, but it rhymes. Which companies spent billions to pull dark fiber across continents and under oceans and saw borrowers like WorldCom, Global Crossing, and others go under. The oil revolution, the shale revolution that prompted U.S. oil and gas companies to issue $350 billion in debt to fund drilling, led to hundreds of bankruptcies after oil prices swooned in 2014. And that's what we're going through right now. Hey, history don't piss up in the rhyme. Going back even further to nearly 1990, the widespread adoption of electric power led to a build-out that saw roughly half of the 3,000 small utility and power companies that exist either disappear or got sold during the brutal decade of consolidation. And what are we doing right now? Consolidation. In each case, there were also long-term victors who inherited infrastructure and reaped the benefits of these expansions in the form of lower cost bandwidth, cheaper consumer prices, and large manufacturers that consolidated to power grids. Here's the big one. The artificial intelligence build-out is being driven by 5 hyperscalers: Alphabet, Amazon, Meta, Microsoft, and Oracle. Right? The Fab Five have thus far made total commitment of $969 billion, with more than 2/3, $662 billion, planned for data centers related leases yet to start, according to Moody. We're almost there, ladies and gentlemen. In 2025, Alphabet, Amazon, Oracle, and Meta, and Microsoft issued about $121 billion in new debt via bonds, compared to $40 billion in 2020. Wow, 40 to 120, that's a big jump. Same thing we're doing now. And the pace is not expected to slow down anytime soon. Wall Street estimates show that AI-related bond supply could be the range of $100 billion to $300 billion this year. Over the next 3 years to 5 years, total data center investments could run $1.5 trillion to $3 trillion, according to the same analysts. Just saying, y'all. History don't repeat itself, but it rhymes. I just showed you. That's the end of this video, y'all. We talk about a little history. We talk about Google. We talk about Microsoft. Microsoft is down, but Google is up. And NVIDIA is down right now as we speak. See? That's the end of the video, y'all. Please like and subscribe to the channel if you like this content. I'm a new YouTuber and share if you choose to. Reggie Empire out. Holla at y'all. Whoop.